The Bank of England on Thursday hiked its main interest rate to its pre-pandemic level to combat runaway inflation that risks soaring far higher as the Ukraine conflict fuels energy costs. The Bank of England hiked borrowing costs by a quarter point, its third increase in a row. The decision came one day after the US Federal Reserve carried out the first of what is expected to be a number of rate hikes this year to tackle decade-high inflation. The UK Central Bank said that the country's annual inflation rate could top 8% this year, as the Ukraine war fuels already sky-high prices for oil, gas, and other commodities. It had previously forecast inflation to peak at just 7.2% in April. The Bank of England even warned that should wholesale energy prices continue to soar, inflation could potentially be several percentages more higher than was prior estimated. 8 members of the bank's 9-strong Monetary Policy Committee, including its governor, voted to lift its key rate by a quarter point. Regarding inflation, the invasion of Ukraine by Russia has led to further large increases in energy and other commodity prices, including food prices. It is also likely to exacerbate global supply chain disruption and has increased the uncertainty around the economic outlook significantly. The latest official data showed that the UK's annual inflation hit 5.5% in January, the highest level since 1992. Inflation is rocketing around the world, also as economies reopen from the pandemic. The UK's February inflation data is due on Wednesday. This coincides with a budget update from the government, which is facing higher repayment costs on its vast pandemic bill following the rate hikes. The Finance Minister, Rishi Sunak, has already announced a major tax hike starting in April on the UK workers and businesses. That same month, a cap on domestic gas and electricity bills is set to significantly increase. While Britain's unemployment rate has fallen to its pre-pandemic level, wages are eroding at the faster pace in 8 years as prices soar. UK consumers now face rising borrowing costs that will compound by higher food and energy bills and tax rises to boot. He noted that while rate hikes will mean that savers get a bit more return on the cash held in their bank, elevated inflation means they will actually be worse off. The bank also confirmed Thursday it would stop the reinvestment of government bonds under its massive quantitative easing stimulus, which now stands at £867 billion or $1.1 trillion.